Hello, everybody, and welcome to the Asset Preservation Hour. I'm your host today, Paul Gabbard, with my very special guest, Mr. Stewart Willis, co-founder of Asset Preservation Tax and Retirement Services. Welcome back to the show, Stu.
Thanks so much for having us.
It's good to have you today, man. I mean, I get excited about these topics because we're talking about, retiring, making sure people have a stable retirement, right? Security.
Absolutely.
And one of the things I wanted to ask you on the front of security is starting right out of the gate is, what's going on in the markets right now, Stu?
Well, you know what? I feel like I'm a broken record because I keep saying the same thing at the beginning of these shows. The volatility is through the roof. It's incredible amount, crazy amounts of whipsaw up and down. We're seeing, obviously, markets are relatively high. The interest rates are incredibly low. But this volatility is just, an absolutely tremendous thing. I think, the volatility oftentimes is caused by the supply chain issues. I think, people are still really concerned about supply chain. I happened to be out in California and out on a boat, and I was able to see these shipping vessels that, they've moved them further and further out to sea, and just to kind of hide them from public view, It's crazy. But, go look at the car dealerships, right? When you go there and there's all used cars at your local car dealership, it's a problem, right?
Yes.
When we don't have cars, because just remember, let's talk about cars.
Yeah.
When President Obama, saved the car industry, so to speak, a lot of people were in an uproar. But remember, our car industry is really, really important because it's a national security concern.
Yeah.
Because it's not just about buying cars.
Yeah.
It's about having, being able to mobilize
Sure.
an army if we need to, and generate some material here. So, the Defense Production Act is a really important thing, but supply chain's a major issue. But I think that the word on most people's mouth today is inflation.
Boy, that's the truth.
I mean,
wow.
Everybody can feel it. You go to the gas tank or the gas station and you see these stickers on there that said, Biden did this. And I don't mean to get political here.
Yeah.
It all depends. It's different people feel differently about it, but whatever's causing it, whomever's causing it, we've seen a 50% increase in gas here, over the last year from, this time last year. Meats are costing dramatically more if you can buy them. Things
Sure.
are just very, very short, in terms of supply. So these supply chain issues are causing massive inflation. People are realizing that all of this money they've kept to the side in their banks is becoming less and less valuable. So, I have clients, I have this really special client, I love him to death. I think he's the greatest guy ever. And he's just nervous to make a move because he's had all this money in cash. But, finally with this inflation, he's realizing, oh my gosh, this money's becoming less and less valuable. It's kind of like buying, if there's no inflation, it's like buying into a losing investment that keeps losing and losing and losing.
That's right. It's taking a
every
pay
year.
cut, right?
Yeah, no doubt.
Yep, there's no doubt about that for sure. So you mentioned that markets are all-time high. So what are people feeling about that? I mean, is it causing fear? What's happening?
It all depends on who's, driving the truck here. Oftentimes, I think a lot of investors that have been self-investors have really, come to realize that, hey, you know what, rising tides float all boats, that they've done well because the market's done well. Other people a little bit delusional about it. They think that they're, outsmarting the market because they've made 400% over the last 12 years, even though the market's made 600%,
Right.
I mean, it's, I always say a blind chicken could have picked a good stock over the last 12 years, right? But now, the chickens are coming home to roost. And so you need to make sure that, you're in a position to not get completely exposed if we see these downturns.
Yeah, and don't be complacent is what part of that happens, to your point, right? As you're growing, you run the risk of being complacent.
No question.
Yeah, so let me ask you this question. So what strategies do you have in place specifically to guard against these downturns, Stu?
Well, I think what's important, first and foremost, most importantly, is for people to know their options, right? And first of all, it's important to consult a fiduciary, whether it's us or somebody else. Make sure you consult a fiduciary. That should be your minimum. If you ask if they're a fiduciary and they say yes, your second question should be, are you a broker? And if the answer is yes again, well then, number one isn't 100% accurate. You can't be both, right? You can't be both a broker and a fiduciary. You may act in a fiduciary capacity, but people are parsing words when they talk about the fiduciary, right? But number one, people need to know their options. They need to make sure they understand what is the full range of available strategies available to them. For example, we're talking about all this diversification and all of these different things that I'm telling people they need to do in their portfolios, but they feel helpless because all of their money is in their 401k. They're 60 years old, got this money in a 401k. And what people aren't realizing is that when you turn 59 and a half, oftentimes there's a lot of options that open up to you. Right? Like, for example, you at 59 and a half usually have the ability to roll out money out of your 401k or thrift savings plan into a professionally managed, fiduciary overseen account. And people don't realize that. They think they're helpless until they actually quit their job. So I've actually seen clients that have come in and said, hey, you know what? I just retired because I wanted to get my money out of the market, but I'm going to go back to work in 6 months. They think they're tricking the system when they all along had the ability to be able to roll it out. There are some downsides to it. You want to make sure you're making an informed decision. There are some downsides like loan provisions and ERISA protections, things like that. But there's some tremendous upsides too. But you want to make sure you balance all of them. So number one, I would just say know your options. Absolutely. Number two, make sure you have true diversification. And I think that really is where people, don't know. They think they're diversified, but they're not really.
That's the truth. But do me a favor, hold that thought. We come back, we're going to talk more about diversification, okay? But I understand you have a wonderful offer for the viewers. Would you share that for the good folks of Phoenix?
Yeah, absolutely. What you have to do today is if you give us a call at 833-652-7829 or click on that QR code that's right there on your screen, what we're offering today is a complimentary portfolio review. And in that complimentary portfolio review, we'll take a look at any risks that you're taking in your portfolio, any fees that you're paying. Are you really diversified? And, are you going to achieve what you want to achieve in life? It's not about, making sure that your money is doing what we want it to do. It's about making sure you achieve your goals, not our goals.
That's a key point. Your goals is the important thing. And knowing your options, Stu, right?
Absolutely.
That's critical. Bottom line, pick up the phone call and set your appointment today. 833-652-7829. We're going to take a quick break. We'll be right back after these messages.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, 5 years, 3 years tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
Welcome back, everybody, to the Asset Preservation Hour. I'm your host, Paul Gabbard, and thank you for being with us today, where our guest has been Mr. Stewart Willis, co-founder of Asset Preservation, Tax and Retirement Services. Stu, incredible first segment. You dove into the D word, diversification. You mentioned that. Can you expand on that for our viewers today? What do you mean by diversification?
Yeah, so I think people misunderstand diversification immensely. And, like I'll see clients all the time that'll come in with these big portfolios. If you've got $1 million saved, they've got 85 positions in there, 85 different mutual funds. And they think, oh, well, I don't have all my eggs in one basket. Well, oftentimes, Paul, they think they're diversified, but they really aren't. Because if all the mutual funds are all buying the same underlying stock, are you really diversified, right? It's It's like that, example you said. If you have, you buy a green sweater at, one store and then you buy them from 3 different stores. If it's the same green sweater, it's a green sweater.
It's exactly right.
You buying it at a different store doesn't make it diversified.
Yeah, exactly.
And I think it's the same thing when it comes to your investments. You want to make sure you have diversification. So there's a few different kinds of diversification I talk about. So number one, diversification of your investments. That means you want to make sure that all your eggs aren't in one basket when it comes to the underlying investments. You want to make sure that there's true diversification. And that's the one thing we do with our analysis is we look deeply to see what do those funds hold. Not just what do they say on their brand name, but what is the underlying stock, and do they own the same stuff? And then we can fix that once we know. But that's really important to find out. Diversification of underlying investments. The other thing that I talk about is diversification of perspectives. Now, diversification of perspectives, to me, is probably more important than any other kind of diversification. What that is basically, think about this. If you are dealing with an advisor and that one advisor or your spouse is picking all of the funds for you, they are seeing the world through their eyes only, aren't they? And what if they're wrong? So let's flash back to, November of 2020. We have 2 of our, multiple money managers. We have 6 different money managers that we use. But, talking about 2 of them, one of them is an algorithm money manager. The other one is a more strategic money manager. One tends to be a little more conservative. One tends to be a little more liberal. But, just think about this. If you watch one news channel on cable news, you see the world one way. If you watch the other one, you see it completely differently, right? 2 different smart people can see the world drastically differently, right? And when we flash back to November of 2020, one of our portfolio managers believed that, hey, there was too much risk in the market. If Biden wins, the market could fall because of, higher taxes, higher regulation. I got tons of calls from clients that were concerned the market was going to fall before the elections. One of our other money managers, who's based on the coast, actually based in San Francisco and New York, and they are the biggest money manager in the world, they actually did the opposite. They believed the market would benefit from Biden being president because of all the spending that would ensue. Well, they were right, and the conservative ones were wrong at this time. They're not, and it's not always the case. But here's the point. What if you're wrong? Or what if your advisor's wrong? If you're sitting across the desk from that one advisor picking all the positions for you, I say, man, that's a tremendous amount of risk to get, to basically put your entire life savings in how one person sees the world. Because what if they're wrong and they see it differently? So diversification of perspectives is super important. We also talk about the diversification of tax strategy or tax class. So we talk about IRAs and Roths all the time. You want to make sure that all your money isn't just pre-tax. So if you've done a great job of putting away all this money, you put it away into your 401k or you put it away into the IRAs because your tax people say it's great. Well, guess what? When you take it out, you're going to have a lot of taxes to pay. And, with a Roth, you don't have to pay those taxes, right? But, I told you the story off air. About this client that I have that basically he's an 82-year-old guy. We were doing his tax return last year. He came in and I was looking at his portfolio while doing his tax return or delivering his tax return. And I just said, sir, you must be incredibly proud. You've achieved a ton. And the man started crying. He started crying. He said, Stewart, what the hell for? Yeah, I've got millions of dollars, but my wife is dead. I never took those trips we should have taken. We never took those cruises she wanted to take. She really wanted to take a cruise to Alaska, and I didn't do it. So my question to you is, why? What is your why? You know, if you just want to die with millions of dollars and, you know, just to show off this portfolio to your friends, the wrong company for you. We're not the right place for you. You know, if you're looking to be able to enjoy the heck out of life and know that you're not going to run out, you know, I think we may be the right call. You know, it's worth seeing whether or not we're even a good fit. But I think there's diversification of tax classes really matters. But also, what's very important as well is a diversification of strategies, of investment strategies. So, you know, we have, you know, I talked about the two of the money managers we have. One of them's more strategic. You know, there's a big approach out there that says, hey, don't pay any money manager at all. Just put it in the S&P 500 and it'll do better over time. And, you know, one of those strategies is basically what we call a passive or a static model. And I have a slide here I want to pull up for you. And this is the classic asset allocation model where, you know, when you're a young investor, you have more equities than you do bonds. So an 80-20, 80% equities, 20% bonds or cash, or some people even have 100% equities. And then as they get older, closer to retirement, they start taking some chips off the table and getting rid of equities and putting it into a safer positions. Well, that's basically a static model. Let me contrast that with you guys to the tactical model that we have. And this tactical model is that algorithm money manager I talked about. Essentially, they have identified 6 distinct stages in the economic cycle, and they believe that during each of these different stages, there are specific investments that do well. So, for example, if you know the market is about to tank, you don't continue to buy equities. You get rid of those. When there's inflation concerns, you get rid of those inflation-sensitive positions. You know, just think about this, Paul. The logic behind it, right? If the market's doing well, you hit the gas. If the market's doing bad, you hit the brakes. Some of these passive approaches are just saying, hey, you know what? Go ahead and take the loss. Over time, you'll do well. Well, let me just tell you, all those people who say that, you know, don't know our clientele very well, you know. Whether I'm in my, you know, Sun City Surprise office or in Scottsdale or here where we're filming in Tempe, you know, people universally feel the same way. You know, they do get nervous when the market starts falling. When the market is going down, I'm getting, you know, my cell phone rings off the hook. All of my financial clients have my direct number. They can reach me on my cell phone, you know, 7 days a week. But those people who think that they're not afraid of the market, as soon as we see a drop, they're the first ones to call. You know, and so you have to know what kind of risk tolerance you have and make sure that you have multiple strategies in place. Some passive approach might make some sense, some strategic, and also some tactical. But don't have all your eggs in one basket. Don't have one person determining whether or not you succeed or fail. That's why we use the biggest money manager in the world to oversee, you know, some of our portfolios. We have our algorithm manager. We want to make sure that all your eggs aren't in one basket.
Let me ask you this, Stewart. What do you think about Roth conversions, first of all? And why do you think advisors don't talk much about Roth conversions with their clients? What's the purpose?
Well, yeah, so I talked a little bit about Roth there, you know, when I talked about diversification of tax classes. And I'll tell you, it's an interesting point because a lot of people know, they all realize, you know, that Roth is better, right? And they just don't know how to implement it, right? But a lot of advisors aren't talking about it because that involves a conversation around tax. And most, you know, financial advisors that work for these big box firms are prohibited by their firms from giving any sort of tax advice. It's precisely why we have a tax office in asset preservation. It's not to just prepare taxes. Yes, we're going to do 800 plus tax returns for our financial clients this year. But, you know, that's not the purpose of the tax office. It's not tax preparation. It's about tax planning, you know? And I think it's really important to make sure people have a proper tax plan as well.
And we're going to talk more about that when we come back. But would you remind the good folks out there in Phoenix what you're offering today if they reach out and call?
Yeah, if you reach out today, you know, we're talking about tax planning. What we'll do is take a look to see if there's any sort of scary, you know, tax time bombs in your portfolio. Give us a call at 833-652-7829 or click on that QR code. Super easy to click on the QR code, go to the website, you click on the complimentary portfolio review, you answer a few questions, and we'll have a ability to give you a second opinion, but you have to take action today. Give us a call at 833-652-7829. We'd be glad to take a look at all the fees, the risks, the diversification of your portfolio. We'd be glad to give you that second opinion, but you have to take action.
And as promised, we come back, we're going to talk more about tax strategy versus tax preparation planning when we come back after these short messages. Stick around.
This is the story of how you get from here to there. Right now you're here, but in the future, you want to be there. And from here, there looks pretty good. But so few get to there. Why? Well, of those who do make it, some will have luck, but most will have a strategy. They will save and invest, grow and protect, and they will work with advisors who will help guide their way. If you're looking to get somewhere, to get there, we know how to set a course. It's what we do, and we do it well. We're investment specialists, retirement advisors, insurance experts, and financial planners. We have innovative wealth tracking tools to monitor your progress every step of the way. Wherever you are now, we can help you get to where you want to be. The road between here to there is shorter for those who know the way.
Welcome back, everybody, to the Asset Preservation Hour. Again, I'm your host today, Paul Gabbard, and I want to thank you so much for being with us and investing your time. We really appreciate you, and we appreciate Mr. Stewart Willis for being our guest today and sharing with us just some incredible information, Stu. But as promised, we wanted to talk to people a little bit about tax, because that's a big deal in retirement, and there's a difference between tax preparation and tax planning, isn't there?
Yeah, absolutely. I mean, obviously, we deal with taxes year round at our firm, and I think most people are used to, doing tax preparation. What tax preparation is basically when you fill out the forms, you go visit the nice person doing your taxes. I'm sure they're great. You spend a hour there, and you walk out with a tax return. And that's just filing your taxes. That's tax preparation. And tax planning is actually forecasting and planning and creating a strategy over the next several years to make sure that you are intentionally creating a tax plan. Now, tax preparation is one of those things where, and trust me, I have a tax office. We're going to do 800 plus tax returns this year. And, these people, they work their tails off. They're working 6 days a week, 12, 15-hour days. All they're doing is preparing taxes. And if you are trying to get tax advice, tax planning advice during tax season, you are missing the boat. You're barking up the wrong tree, because these people are just trying to get all of these tax returns done and correct. And we're super concerned about double checking and triple checking to make sure there's the numbers are accurate, because the one dirty word in taxes is errors. There's tons of errors in tax returns, which is why we have an enrolled agent that does the interview, a certified tax preparer that does the data entry, and then another CPA that actually does the review. So tax preparation is great. You want to get it done and get it accurate, but tax planning is what we should focus on. And what tax planning is about looking at how much tax are you paying today and how much are you going to be paying in retirement. And maybe it's important to take advantage of your current tax environment. I have a slide here of tax brackets. You've got to put into perspective where we are. The first one is a comparison of the Obama and Trump tax brackets. The blue is, and I call them Obama and Trump, but it's just kind of a before and after the Trump tax cuts. The blue was the 2017, and the red is after the Trump tax cuts. These are destined to sunset in 2026 if nothing changes. But you can see that we are in this very, very efficient window. The other thing I want you to look at here is I have another slide here that is a look at tax brackets. A little bit small to see, but if you take a look at the one on the right, married filing jointly, this will give you an understanding of how I look at taxes and how our firm looks at it. If you take a look at the 10% bracket, going from 10% to 12% is a small jump. Going from 12 to 22 is a huge jump. 22 to 24 is a small jump, and then 24 to 32 is a big jump. So what you want to try to avoid, Paul, is jumping into these way bigger brackets without a real purpose of it, right? But the key, Paul, is to basically make sure you're taking advantage of your bracket. So I see, I'll use an example of, my sons play basketball. They have this great trainer who works, he's an assistant principal at a great public school, phenomenal basketball coach. And he's been putting away all this money into these 403B accounts, tax deferred. Well, listen, the guy's got a few kids at home. This guy's paying 10% tax.
Right.
Yet he's doing tax deferral to a time where he's going to pay a higher tax bracket.
Yeah.
So the kids are going to move out. You're going to lose the deductions. So you want to make sure if you're putting money away, it doesn't make sense to put it away at a period where you're going to pay 12 or 22% down the road, or if the Trump tax cuts go away, you're going to pay 25 to 28%. But you're going to defer taxes when you're at the super low rate. You want to take advantage of it, right?
Yes.
And that's when you start looking at tax planning tools like Roth conversion, tax harvesting from capital gains.
Yes.
We know capital gains rates are looking to go up. At least they tried and build back better. We don't know what it's going to look like in the future here.
Yeah, no doubt. I hope you recorded that little bit of segment right there, because that you want to keep replaying. To Stu's point, you got to take advantage of that low bracket while you have it.
Yeah.
That's important. Do it while you have the opportunity.
Yeah, and just think about this. The key is, if you are going to jump from a 12 to 22% bracket, there has to be a purpose, right? You want to make sure that over time, that'll, for example, keep you in the lower brackets for the rest of your life. Don't just pay tax to pay tax. I'm not a fan of that at all. But what I am a fan of is you having complete control over your money. We have clients, for example, that have special needs children. They've saved, $1 million in their 401k. Their money is going to one of their special needs kids, and they have a trust all set up, special needs trust. But all their money that's passing from their IRA is going to special needs trust. Well, with the Secure Act, the elimination of the stretch IRA, the tax consequence of sending it, you're creating this massive tax nightmare. With a Roth, for example, you don't have any tax bill. So the trust basically receives it and you can distribute it without any tax consequence, or K1s. It basically makes life a lot easier. So strategy makes sense. Structure makes sense. And I think people just don't have any idea of structure when it comes to their investments. And you always say, well, why doesn't the advisor do that for them? Because it can't. Their companies prohibit them from giving tax advice. They're worried about, litigation. Which is why we have CPAs and enrolled agents and tax professionals available all the time to make sure clients know that they're making an informed decision.
Yep. Believe it or not, Stu, we've come to the end of another show. But I want you to remind the good folks of Phoenix what you're offering today, would you?
Yeah. So what we're offering today is our complimentary portfolio review, and we're offering that at any of our 3 locations. Whether you come to this office here where we film at Tempe, go to our Scottsdale office, or our Sun City Surprise office, we're offering that complimentary portfolio review. Click on that QR code that's on your screen now, or call 833-652-7829. But take action today. Do yourself a favor. We'd be glad to give you that second opinion.
A lot of information. Pick up the phone and call today. Thank you for being with us. Be well and enjoy your retirement, everybody.